Welcome to the Holistic Wealth and Health Podcast. Your co-hosts, Jason Smith and Bryan Bibbo, will inspire and teach you how to prosper in your mind, body, and spirit, not just your financial life. Joining forces with field experts, Jason and Bryan are here to help you focus on what matters most in your life, living well.
Hello, everyone. I'm Bryan Bibbo, President and CFO at J.L. Smith Holistic Wealth Management. Recently, I had a conversation with Dave Alison, founder and CEO of Alison Wealth Management, on breaking down the tax management journey. There was so much to talk about that we've split our conversation into two parts. You're currently listening or watching part 2 of our conversation. We have the links to part 1 in the description of today's episode. In this episode, Dave emphasizes the value of tax management as an ongoing, proactive process rather than a one-time event. He explains how strategic planning can smooth income peaks and valleys, helping clients avoid higher marginal tax rates, tax traps, and missed opportunities. Dave also illustrates the importance of aligning tax planning, tax management, and tax preparation to ensure clients maximize what they keep, not just what they make. Hope you enjoy.
Yeah, I love it. And that's a great summary when we think about the order of money. But one of the key takeaways is the tax environment. You spoke specifically to the tax environment out there, right? And we can vote, right? We can vote for who we want in Washington, who we want in our state representatives, all that good stuff. But we really can't control tax law, right? So it's almost like that pendulum needs to swing back and forth. In a high tax environment, you need to do certain things. In a low tax environment, you need to probably almost do the opposite sides of things. So when we speak to kind of that tax environment, what do people need to know right now about the tax environment that we're in, where the tax brackets stand, and maybe if there's excess room, and how can that benefit them?
Yeah, and I want to try to give people a visual to simplify this. Like, life is full of what I would call peaks and valleys when it comes to your income, right? When you have a peak, you're in typically a higher tax rate, right? It's not just with more money comes more taxes, but it's a higher marginal rate. So for example, Bryan, you just mentioned the brackets. Today, they're 10%, 12%, 22%, 24, 32, 35, and all the way up to 37%. So let's say it's a year where you sell your business and you have a windfall and you've got a certain amount of income over that 37% bracket. It means for every dollar of income over that 37% bracket, you're paying 37 cents on the dollar in federal tax. It's not 37 cents on the dollar on every dollar, because some dollars are taxed at 10%, some are taxed at 12%, and that's what gets you to a blended average over time. But that's an example of maybe a year where you hit a peak, right? Maybe the next year, because you sold your company, now you don't have any income. You're in the valley. And so what we want to do is layer in strategic tax management to try to levelize the peaks and the valleys, right? We don't want this big choppy income one year because you might be penalized by having higher marginal rates. And then in another year, your income is so low that you're actually not taking advantage of the lower rates by filling up the 10%, the 12%, the 22%, and so on. And so tax management, to me, a big part of it is smoothing out the peaks and the valleys. And the importance of this is if you don't use it, you lose it. So you're in the 12% bracket, and maybe you have another $10,000 or $15,000 worth of income you could realize without actually leaving that 12% bracket and going into the 22% bracket, which you don't want to do that. That's a big jump from 12% to 22%. But if you don't realize that income, you lose that opportunity to fill up that 12% bracket forever. How could you realize income? You could do things like Roth conversions. You can sell an asset. In fact, if you're in the 12% bracket, you might even have capacity from a capital gains perspective to sell some post-tax money, realize a capital gain, and not have to pay any tax on that. versus like if you deferred that tax into a later year, and now maybe in a later year, that gain is accumulated even larger, and you go to sell that, that gain might actually push you into the 22% bracket or create a 15% taxation rate on your long-term capital gain income. So it really is like a game of chess, right? And we don't want to squander these opportunities, because one of the biggest mistakes I see in tax management is you miss years to smooth out the peaks and valleys. And as soon as the clock strikes midnight on December 31st, it's use it or lose it forever.
Yeah, that's so powerful. Now, when we think about some of the things that maybe people can try to avoid, I want to start off with Dave, and I'm sure you've ran into people in your career. But first and foremost, I want to speak about like shady characters out there. I'm sure you've ran into it where a client comes to you and goes, "What about this tax strategy? I heard it from XYZ person." And, it just, when the simple thing is if it's too good to be true. So I'm sure you've ran into that before and watching out for those characters, and you tell your clients too. But what other tax traps or things that someone could run into that could catch someone off guard, and how can they be avoided?
Yeah, well, the shady characters are a dime a dozen in the tax business, it seems like. Usually they're unlicensed people. So, I before I get into like the actual legitimate tax traps, I would say that like Bryan, I know on your team and in our organization, like I'm an enrolled agent admitted to practice before the IRS. That gives me the highest practice rates of the IRS, right? So think about like CPAs, tax attorneys, enrolled agents, anyone also who's a fiduciary, right? So Bryan, I know every advisor in your firm, even if they're not necessarily a CPA or an enrolled agent, I know you guys have those people on the team that are collaborating together, but you should be working with a fiduciary. A fiduciary is somebody who has a legal obligation to act in your best interest, because to your point, I see these, I would call them tax scams all the time. And why it's so prevalent that in fact the IRS produces something every year called their dirty dozen list. So if you ever want to see some sketchy stuff, go to the IRS's dirty dozen list. That's not where you want to find yourself playing. But the other ones that like aren't some like promotion, right, of a tax scheme are just tax traps that exist in the tax code. And what I mean by that is, Bryan, what's the highest tax bracket today when you look at the published tax brackets?
When we look at it, the published tax bracket, we're going to say single, married, filing joint, it's 37%.
37%. And so imagine you have a client that is heading into retirement. They've got Social Security income. They've got some required minimum distributions or IRA income. Maybe they have a little bit of dividend income from their portfolio or some interest they're earning on their bonds or their bank accounts. And they call you one day and they say, "Hey, Bryan, we're going to go on a trip to Italy. We need another $20,000 for this, 40th anniversary vacation that we're going to take together." And so you and your team, not you and your team, because I know your team's above this, but maybe another advisor calculates the numbers and they say, "Okay, Bob and Sally, you guys are in the 22% tax bracket. So 40,000 at 22% is $8,800, right? 22% of the 40,000. So we withhold that 8,800 and you net the rest." Well, imagine to your surprise that taxes come around. And when we calculate your taxes, now we find that you don't owe 22% on that $40,000 withdrawal. You now owe almost 50%. 50% isn't even a bracket in the tax code. How is that possible? Well, it's possible because of a couple things. If you take that withdrawal out of your IRA, that pushes your taxable income up. It also could create more taxation of your Social Security income. So now where maybe some more of that Social Security income was otherwise tax-free, it becomes taxable. Maybe it pushes you from a 0% qualified dividend tax rate into a 15%. Maybe it phases out more of your deductions, like the senior over 65 bonus deductions that just came about because of the one big beautiful bill. And so we need to be really strategic about where we take money from when you're in the distribution phase, because one wrong decision could impact 10 or 11 variables on your tax return that could really create a whole lot of unnecessary or avoidable taxes.
Yeah. Dave, there's a specific topic that we've kind of danced around a little bit here today, and it's the marriage between asset management and tax planning. And when we think of those two, there's a lot of asset managers out there. And if you look at the statements, right, a lot of statements out there say, we cannot give tax advice. So when you think of asset management and all the things that we're talking about, why is it so crucial to have the asset management and then also the tax planning and then the tax preparation kind of all married into one?
Yeah, well, I think if we go back to our earlier statement, hopefully it's rooted in everyone's mind. It's not what you make, it's what you keep. And so if you've got, people working in silos, you're just not going to get the most efficient approach. It's very much like the medical industry. This is the Health and Wealth podcast. And like for me, I would love to have my primary care doctor coordinating with my nutritionist, coordinating with my personal trainer, coordinating with maybe my functional medicine doctor, getting the best advice for me if I had, some sort of, high risk medical procedure going on, right? Like the more minds working together, the better, right? They could challenge each other. They could have accountability that the actual plan for me is optimized, right? And so I think that's very similar to our approach here. I'd use the analogy from a tax side of things, that think about if you were going to go build a house. The first thing you would do is you would hire an engineering firm, right? You would hire an architect to lay that blueprint out for you, to build the plan, to build the design, to make sure you're really happy with the blueprint and the design. Mm-hmm. But that's not enough, right? You can't go live in your design. You then need to go hire a builder to take that design and bring it to life, to actually go build it. The third thing you do is once that building is done, I'm not going to go live in it until an inspector has signed off that everything's up to code, right? And so that's very similar to what we do with tax planning, tax management, and tax preparation. Tax planning is like the architect building the blueprint. Tax management is the actual implementation. And then tax preparation is kind of just signing off that, yeah, this thing's all up to code. And I think that's very important to integrate those three things together. And what we typically see is the missing link is tax management, because tax management requires careful coordination of investments, retirement income distribution planning, insurance planning, liability protection. So having those two things coordinated is what really creates the magic of tax management. Because how many times have you seen, Bryan, where a client will come in and they say, well, I'm working with this CPA. And then you'll say, okay, when's the last time that CPA sat down with you and built a full tax strategy and then coordinated the implementation with your investment advisor, where they do monthly check-ins to make sure that they're taking advantage of everything they could based on economic conditions, market volatility, your income needs. And I've been doing this for 20 years, and I can count on one hand the amount of clients that have come in and said, yep, my professionals are doing all that proactively for me. It really doesn't happen. The place that it happens is the ultra, ultra rich, right? If I had the fortune of sitting down with Jeff Bezos or Elon Musk or Mark Zuckerberg or somebody, and I would imagine their teams are coordinating and all sitting at the table together for that ultra high net worth billionaire type of client. But the rest of us, right? You're kind of like a pinball having to get bounced back and forth, and that creates a lot of inefficiency. So our model, as you know, Bryan, in creating these 5 pillars of holistic wealth management is to integrate all of those things on behalf of our client.
Yeah. No, that's great. It's that whole differentiating factor of marrying the two things together. It's exactly that cornerstone phrase that we had talked about before. It's not about what you make, it's about what you keep. But the last thing, two last things I want to kind of land the plane on here is when we think about this tax management journey, we got to explain that it's not kind of hey, 1 year you're going to do this and then you're going to forget about it. It can't be a one-time event. And as laws changes and on financial life changes, that the plan needs to continue to change, right?
Absolutely. I mean, taxes are not intuitive, right? Intuitively, I would say, I don't want to pay tax now, I want to pay it later. But that decision might actually cost me or my family way more later. And if there's one thing that I'm pretty confident about, is that life is not static, it's dynamic. It's changing all the time. Our situation changes, our health changes, our goals and objectives change, our children or grandchildren change, our income needs change. And with every one of those changes in our personal lives comes the opportunity to assess the ability to reduce taxes, not only today, but lifetime taxes. And even if our life is as steady Eddie as you could imagine, there's another very much changing variable out there, which is public policy. Bryan, you mentioned earlier, we can vote, but at the end of the day, like Dave Allison can't control what the tax code says. And we have seen so many historic tax changes over the last 10 years, including just this last July with the One Big Beautiful Bill, which is huge for driving reduced taxation for almost everybody, whether you're a senior in retirement with some of the new deductions, whether you're a business owner with the opportunity for Section 1202 qualified small business stock, bonus depreciation, Section 179 depreciation, research and development credits. Like, there's an immense opportunity out there, and it's always changing and evolving. So if you're okay with potentially overpaying and not capitalizing on these opportunities, yeah, maybe taxes is a one-time event for you. But I know for most of our clients, they would rather keep that money in their family than give it to the government unnecessarily.
Yeah. Dave, one last thing here. Besides, don't be a part of the dirty dozen or trust anyone in that IRS dirty dozen that comes out each year. What would one message you would want to tell the audience about taxes?
I mean, it just comes down to the 7 words I mentioned earlier. Not all money is taxed the same. And those that figure it out and figure out how to capitalize on it, it's not wrong, right? I mean, again, like, I think some of the billionaires get a bad rap out there. The reality of it is they've figured this out long ago. I mean, think about when you hear these stories that people like Warren Buffett or Jeff Bezos or Mark Zuckerberg pay less in income taxes than a lot of their employees do. There's a reason for that. They know that not all money is taxed the same. They know that W-2 income, ordinary income, the same type of income you might get from like your retirement accounts also, that's taxed at ordinary rates all the way up to 37% today. They realize they'd rather be an owner of capital. Capital is more preferentially taxed, long-term capital gain or dividend income. So when these people go and negotiate their pay packages, I just saw Elon Musk negotiated up to $1 trillion pay package, which is mind-blowing. But do you think he negotiated a high W-2 salary? No, he doesn't want any salary. What did he negotiate? He negotiated stock. Stock is taxed at more preferential rates. Like, these people understand not all money is taxed the same. And you don't have to be a billionaire to do this, right? Anyone. I can't tell you the savings that we bring to somebody that's worked hard, saved their entire life, maybe has amassed $1 million, $2 million, $3 million of retirement assets. And there's opportunity to reduce the amount that the government gets, which keeps more in their pocket for their own enjoyment and fulfillment. And I know, Bryan, that's what gets us out of bed is, making sure our clients can put their money to work in ways that bring them more enjoyment and fulfillment. And that's what it's all about.
Yeah. Amen to that, brother. And as always, we appreciate your thoughts, your wisdom, your insight that you're able to share with us, the advisors at Prosperity Capital Advisors, and the audience that's watching and listening to this. So as always, Dave, talk to you soon. Appreciate you. Thank you for being a part of this.
Thanks, Bryan.
Thank you for listening to the Holistic Wealth and Health Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please call 456-833-7000. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. J.L. Smith Holistic Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through J.L. Smith Holistic Wealth Management are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including, but not limited to, age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the investment advisor public disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.